In this video, we're going to break down the most recent trade idea we've got from the Flux news show, and it's all about the refinery margins and more specifically the fuel oil versus Brent crack. So you can put this trade on or any other trade in the oil complex and the global oil complex with Onyx Markets, a one-of-a-kind free trading platform that you can't find anywhere else. So I hope you enjoy. Okay, so we spoke on the Flux news show about how the market's kind of started to normalize a little bit. You know, we've had a lot of headline fatigue, right, Harry? We were talking about, and how all the hype and the outright prices and the macro events after the OPEC meeting have a little bit been pushed to a side now. And now we're looking forward to maybe more some industry specific stuff. And we highlighted that the refinery profits, right, the product prices minus the feedstock prices, i.e. the crude prices, they've been very, very strong for quite a while, kind of unusually so. And that can be sustained for a certain period of time, but it does tend to come out of the wash eventually, because the stronger these refinery profits are, the more refiners buy the crude, the more they run the crude. And if there is an oversupply that analysts and the general consensus seems to be, then that needs to find its way into more product oversupply. So why don't we go over the refinery margin prices first? Do you want to just get that up as a graph?
Yeah, so on the screen now, we've got the rolling month one refinery margin. So yeah, you can see, I mean, where are we looking from? We're looking from end of April. So yeah, I mean, look, since the 22nd of April, that margin's had, that's run up as, a $2.50 a barrel run up on the rolling month one margin. And this is a combo of all the refined products, so gasoline, diesel, fuel oil, naphtha, even LPG. So yeah, you can see that the kind of margin kind of topped out at 880 at the start of May, and then yeah, we've been kind of hovering around between 8 and 860 between then. But yeah, the argument we made in the on the podcast was, yeah, these margins have been high, and if the physical market is kind of coming back into the picture with all the headline fatigue, then maybe refiners are going to start to look at these margins and think about, especially the deferred margins, these must be good levels to start hedging if they haven't done already.
Yeah, and I think if we zoom out even more, I mean, to be clear, this is a refinery margin benchmark, right? We don't know every refiner's yield of products, and that can change, right? They can produce more gasoline than diesel, and so on and so on. But this is a rough, reasonable proxy for what we think general refinery margins are. But either way, it's about the trend, and it's been rallying quite a bit this year from much lower levels. So that's why we've maintained a kind of spot market bullish crude view, because it's just ultimately, if refiners are making a lot of profits, they're the ones who buy crude. So that holds. But yeah, it's the compression argument. At what point do these come back in? Well, it's when there's oversupply, or when there's just simply so much buying of crude that you generally get like a mean reversion of those prices. There's not a lot of reason why it would maintain for so long. The only problem is we've got a situation where the refinery margin in the very prompt can be quite different to the forward curve, as in Q4 or December. So we're looking at June right now. What is it going to be in December, and which one do you trade? And I think we'd say, generally speaking, if it's something happening in the very prompt contracts, sometimes you don't want to be getting on the other side of that if you can't fully explain why it's so high. And I think we're in that camp. We can't really argue exactly why it's so strong, particularly the fuel oil market. You've got positive or close to positive cracks in Europe for shipping fuel, for residual fuel oil, which is typically a waste product. So that being so high, there's probably a lot of people who want to see it that high, right? And if it's in the very prompt contracts, that's close to expiry, that's close to the physical market, and those guys have good physical information and they have good control over the market sometimes. So I think we'd be reasonable to say, if you're going to sell something on the basis of this refinery margin, you should be wary of doing it in the prompt unless you can very much explain why it needs to compress immediately. The reason why we'd look at it at the prompt as a signal is because it's suggesting, as profitable as it is, that means refineries are going to be running. And at some point soon, or in the next month, 2 months, with refineries coming back online around the world, that oversupply that's been touted in crude needs to be filtered into products, right? And ultimately, that's how the oil gets onto the end user market. That, it gets refined from crude into products, and then it floods the market. And if the end user market can't take it because there's either low demand or oversupply or both, which a situation potentially looks like, then you're going to see that that kind of compression finally in the margin, but it can be lagged. So I guess we'd be looking at saying, look, given how strong everything is, the refiners are going to go for it. They've probably hedged a decent amount for the next couple of months at least. So no matter what happens in the market, they're going to be running. And therefore, I guess we could predict with the general macro sentiment that there's going to be an oversupply at some point this year in the product market. And relative to crude, one of these kind of product cracks, or products versus crude, needs to give. Now, we think this should be fuel oil because ultimately it's a waste product, and historically it's been on way higher levels. That's one thing. But the second thing is the fuel oil crack levels have been high for a few years, but that's not been on the back of OPEC having cut, so extreme to such extreme levels, and they're now starting to unwind it. So this is a bit of an OPEC trade, right? The OPEC crudes are more heavy, they're more fuel oil yielding, and if they're starting to find their way back, similar to the Brent Dubai, right? Dubai starting to weaken because there's more Dubai-related crudes, Dubai-priced crudes, and fuel oil is another one, right? More fuel oil coming out of those types of crudes. So by the end of the year, if we look at December, let's say, by then we should have quite a bit more OPEC crude back on the market and general oversupply. So that product crack differential needs to weaken as a waste product because there's just going to be product filtering to the market, and that's what needs to give as a waste product. And that's kind of the summary. So why don't we get up the deck fuel oil crack in Europe? This is, let's say we're trading on Onyx Markets, the December fuel oil contract. We've, as I said, like the kind of highs are towards this minus $6 level if we're looking at it on a daily chart basis. So it's already been trending down. So I like the setup because it's not really a contrarian trade. You don't need to be guessing, where the top is, because we've had that, quite a while ago now, right? Almost 4 weeks since we've had the high, and we've been trending down since. So I think that's quite comfortably in kind of a trending down territory. So if you were to just enter kind of at market, you're looking at like minus 755, hopefully that around that kind of level for where we are this morning. So then you could quite easily just put in your stop at the highs on a daily basis, which looks like it's around minus 640. We could even go a bit higher just to be conservative, so minus 620, let's say. And it's quite a straightforward trade, right? I mean, we're looking for a long term to play this out. So you want to be having that wide stop, and you want to be just seeing this through. And as always, you've got two options, right? You can either, if your target level really is very low, then you have opportunities to scale in. But just immediately, the risk reward setup looks to me like roughly $1. Let's call it $1.40 as a stop, and you want to have a decent risk reward. So a target level around minus 10 would be very sensible, with OPEC coming back online and a market like more normalized from a supply perspective. So minus 10, I think, it's already been there this year in Q4. So I think that's very, very fair as an initial target. So that kind of sets you up as kind of a roughly 2-to-1 as an initial target, or maybe a bit lower. And but I think really, Harry, the target for this, for holding this for 6 months, we should be looking more towards kind of minus 12, minus 13, don't you think?
Yeah, because you've got a while till Q4 becomes prompt, so that's plenty of time for further OPEC production increases to price in. Like you say, you've got this move that we think is going to happen on this crack. It's got a lot of time to come through. So yeah, definitely looking for 2.5, 3, maybe even $4 or $5 move. And yeah, it's a nice setup because you've got that stop at the high. So yeah, you've got a potentially like a 3, 4, even 5-to-1 risk reward ratio there. And the numbers are very feasible. They're not, this isn't stupid numbers we're looking for. Minus 10 on a Q4 crack is a totally feasible level, especially with what we think is going to happen. So yeah, it's not a far out idea at all.
Yeah, the only thing I would say, usually I would, with a longer term trade, I like the scaling because it can give you a lot of leverage, like we talked about in the last video. You're ultimately buying more and using what you've made and reinvesting it with the same initial drawdown. You can have quite a lot of size on, and therefore leverage and make decent money with quite a reasonable initial drawdown. This time, though, I would say, the fuel oil crack can be very volatile, and it does move with Brent flat price. So ultimately, if Brent flat price starts to get very volatile, so will the fuel crack. And I think as people start to turn their positions, as we're going from a very bullish market to potentially a long-term bearish market, there, as you start to kind of move more aggressively into this trend, I think the volatility will get higher, which means scaling is quite dangerous, right? You could be, trying to sell when it hits an arbitrary level, and then you end up selling when everyone's trying to sell, and you kind of sell a stupid number. Or you'd have to be quite clever with it and wait for a retracement and sell there. But I think the problem with that is you're getting quite cute and you're kind of finessing the trade, which is not, unless you've got a very clear plan. I always kind of tend to think that's not the greatest strategy. So I could see this as one of a basket of trades that are just long term, just quite vanilla. Sell the fuel crack, have that $1.20 stop, let it breathe, and just basically ride it as it trends lower and lower, and kind of look to take profit as the market starts to normalize, either on a level basis, or you start to see signals that the market is just generally lowering in volatility and pricing in more supply across the curve. Because if all the refined products start weakening and the refinery margin gets very low, then actually the opposite happens, right? You've got a fuel oil crack that's a waste product. If suddenly everything's selling off, then the fuel oil crack actually has a chance of rebounding quite aggressively, because refiners will actually turn off their production. So you want to be a bit careful about it. You want to look at the fuel oil crack and its weakening relative to the rest of the refinery margin and relative to the general crude market. So if the crude market is really dumping, if things are really weak, and the rest of the gasoline, the diesel contracts, they're all weakening relative to crude, then that's kind of your signal to say, look, the market's pricing in oversupply, and it might be a good time to take profit on this fuel crack. So there's a little bit of diamonism there for this, but it's just one of the ways to express kind of the refiner margins being effectively too strong relative to the supply outlook. And that's, anything else to add on that, Harry?
No, not really. I think what you said is totally correct. Those waste products are super sensitive to margins. So yeah, you want to make sure that your short position is still justified on the way down if the physical market changes. But yeah, no, nothing really else to add.
Yeah, and I would say, this is only one way to reflect kind of the view we're talking about. I think naphtha crack's actually in a similar position. It's also a waste product, and it's starting to trend lower. The only difference there is I'd say it's actually already quite a short market in the crack, in the naphtha versus Brent. So selling it when everyone's short, you run the risk of being in a crowded trade, whereas I don't think fuel oil market is crowded at all. I think the fuel oil market is that people are very long in the prompt. I think consumers have done a lot of buy-side hedging. So actually, if anything, it's stacked the other way, which is why I quite like this trade as well. But yeah, I mean, Tom, do you want to just give an overview, how, if you want to trade this, how to get in touch and what you're doing quickly?
Yeah, absolutely. Yeah, so you can log into the Onyx Markets platform. Probably the best place to do it is via the downloadable MT5 platform. Either bring up a chart and execute via the chart, or you can just load up the deal ticket directly. Alternatively, you can always call us, and one of our dealing team will be happy to execute the trade for you and talk you through any mechanics.
And I always just like the idea of just reach out and chat about it, right? I mean, this is just an idea. You might not like the trade. It's not like it's the best trade in the world setup we've ever seen. Just discuss it, right? And there might be something interesting off the back, and our team are, very well versed in this market. So that's kind of the whole point. But again, we'll keep it brief, guys. So thank you in the studio, and thanks for listeners out there. Please, all the feedback you can give would be great. What do you want to hear? And again, go to onyxmarkets.co.uk if you want to get involved, or flux.live if you want to see some content, and our Flux terminal as well. So thanks, guys, and see you next time.